Home prices in the metro area of Sydney fell again in April, 21 months in a row of declines. They're now down nearly 15% from the peak in July 2017, according to CoreLogic's Home Value Index. Prices in the most expensive quartile of the housing market dropped even more steeply. During the early innings of this housing bust, there was a rumor that first-time buyers would save the condo market, because in a place like Sydney, they could only afford to buy condos, those that could afford to buy anything at all, and condo prices would hold up, it was said. But condo prices are catching up and are already down over 10% from their peak. Home prices in the Melbourne metro, the second largest market in Australia, lag Sydney by about a few months. In April, they were down over 10% from their peak in November 2017, with the more expensive quartile of the market down 15%. And this debacle is happening even as the Reserve Bank of Australia's policy rate has remained at a record low and mortgage rates remain near record lows. This is not a bubble that got pricked by higher interest rates. On the contrary, the RBA tried to maintain the bubble by lowering its policy rate in August 2016 to the low where it is still today. Over 60% of Australian housing market value is concentrated in those two metros. In Perth, where the mining bust took place, home prices peaked in 2014 and have now dropped back to levels first seen in 2007. Home prices in Darwin also peaked in 2014 and have dropped back to levels not seen in years. In other cities, home prices have seen smaller declines, and in some cities, prices are still up from a year ago. So as the housing bust progresses in its methodical manner, what's next? Will the housing bust trigger a mortgage crisis that hits the big four banks and with them the remainder of Australia's financial system to the point where there's a banking panic and a financial crisis in Australia? And what will this do to the global financial system? Ladies and gentlemen, I'm Wolf Richter of WOLFSTREET.com, and you're listening to the Wolf Street Report. It's Sunday, Cinco de Mayo, 2019. By any measure, Australian households are among the most indebted in the world. Most of this debt is housing-related debt, and it includes debt associated with rental properties that households have speculated on, often with interest-only loans, and leveraging their other properties to buy new properties. So this debt is backed by homes whose values have dropped, and the trajectories of those drops are not indicating any kind of bottom. Homeowners and investors who bought over the past 4 or 5 years, or people who have refinanced their mortgages to cash out some of their equity, or people who have leveraged the equity in their existing properties to buy more properties, and that's a lot of folks, are most at risk because they bought at the highest prices and are now sitting on the biggest losses. Mortgages are concentrated at the big four banks, and they are the Commonwealth Bank of Australia, Westpac, ANZ, and National Australia Bank. Their combined stock market capitalization amounts to 375 billion Australian dollars, or nearly 20% of the total market capitalization of the stocks traded on the Australian Stock Exchange. These four banks rule. There are a few smaller banks with a national presence and a bunch of credit unions and building societies and mutual banks that provide some limited banking services and are authorized to take deposits. And there are large foreign banks, but they don't have much of a retail banking presence. So what will it take for this financial system to go into crisis? Financial crisis is a latex term that can be stretched in many ways. For our purposes, a recession or even a steep recession or a stock market crash is not a financial crisis, but a more or less routine occurrence in the cycle. But a financial crisis is not a normal part of the cycle, well, except perhaps in Argentina. A financial crisis is usually related to a banking crisis, when banks begin to topple and credit freezes up, when companies or governments can suddenly no longer borrow enough money to service existing debts and fund operating expenses. A financial crisis is associated with a financial panic. It involves all kinds of problems, such as a deep recession, widespread asset price crashes, markets with no liquidity, defaults of healthy companies that are suddenly cut off from daily funding, and the like. In emerging market economies, financial crises involve a currency crisis and fears that the government will default on its foreign currency debts. There have been many financial crises in my lifetime, but only one that had a long and deep global impact, the big one, the U.S. financial crisis that triggered the global financial crisis. The other financial crises only caused some ripples across the world, though all of them caused pain in the region where they occurred. Some of the recent examples of run-of-the-mill financial crises are the Argentine financial crisis that started in 2018. The IMF is now trying to bail out foreign currency bondholders. And the 2014 Russian financial crisis, which included a currency crisis and the banking crisis. The Greek financial crisis that started in 2010. It consisted of a government debt crisis, a government default and haircut for bondholders, the collapse and bailout of banks, and a deep economic crisis. The Icelandic financial crisis that started in 2011, the prior Argentine financial crisis that started in 1999, the 1998 Russian financial crisis, the Asian financial crisis of 1997-98, the 1994-95 Mexican financial crisis, and so on. So financial crises happen a lot, but only the big ones take down the global economy. And where does Australia fit in? Australia's housing bust is taking on special proportions. Part of the reason for this is that it faces a slew of headwinds. Each one of them would be capable of cracking an overpriced market, but all of them are coming at the market simultaneously. So here are some of them. 1. Prices are too high for average households. After years of sharp price gains that outran wage gains, unaffordability in Sydney and Melbourne has turned into a crisis. This eliminates a big part of the potential buyers. 2. Enormous household debt, mostly related to housing, just as collateral values are now declining, and that's limiting what households can buy. 3. The exposure of the bank's mortgage shenanigans and wrongdoing. Some of these things were first exposed by the media and eventually, and very gingerly, by regulators and ultimately by the Royal Commission into Misconduct in the banking, superannuation and financial services industry, as it's called. These revelations and the regulatory crackdown are putting a damper on these shenanigans, which makes it much harder to get liar mortgages, and suddenly another layer of potential buyers is eliminated. 4. These revelations and the regulatory crackdown have resulted in tighter credit conditions. Banks are now scrutinizing borrowers thoroughly. They have tightened up underwriting standards. Liar loans and other shenanigans are now difficult to pull off, and regulators have cracked down on interest-only loans for investors. 5. A surge in new supply from a historic construction boom, including a flood of new condos that has gotten the Reserve Bank of Australia to fret, not only because of the pressure this oversupply is putting on prices, but also because developers are now at risk of defaulting on the bank loans. 6. Consumer sentiment has turned on real estate. Years of hype have been replaced by intense coverage of the banking shenanigans and the housing bust itself, and it is clear to everyone by now that the markets in Sydney and Melbourne are heading south. So the inevitable question arises, why buy now if you can buy later for a lot less? 7. Chinese investors have gotten cold feet after seeing how their life savings are sinking into the ground in Australia. In terms of the marginal buyer that sets the prices, Chinese investors have been a powerful force in Australia's two big metros. But they like investing in hot markets, not in a housing bust. In addition, China's capital controls have started to work. And since last year, CoreLogic noted a substantial reduction in foreign buyer activity. The Reserve Bank of Australia is now starting to publicly fret about financial stability, following with a good lag what the IMF has long been fretting about. These things move in slow motion. In the US, the first cracks in the financial system became visible in 2005 to where even I could see them. From that point on, it took 6 years before the housing bust bottomed out. Australia is barely into this process. The housing bust in Australia puts banks at risk from two sides. From mortgages taken up by homeowners and speculators and the cross-leveraging of properties that now face sharp price declines. and two, from developers that will have trouble unloading their properties, even finishing the projects, and will likely end up defaulting on the loans. And so the housing bust is creeping closer to the banks. And there's a good chance that this process gets messy in due time and picks up elements of a panic that might turn into a full-blown financial crisis in Australia. No doubt, if the big four banks begin to topple, they will be bailed out, as the biggest banks in the U.S. were bailed out. Neither the government nor the RBA have any interest in presiding over the historic mess a collapse of one or more of the big four banks would produce. If it gets this far, it's already a full-blown financial crisis. But here's the thing. Australia's economy is relatively small. Its GDP is about 6% of US GDP. The Australian economy is a lot smaller than the economy of California or Texas. Australian financial products are not spread out all over the world in thick layers as US financial products had been, such as trillions of dollars of mortgage-backed securities. And the global financial system has not gotten hooked on the Australian dollar or Australian financial institutions. So a financial crisis in Australia will cause some ripples globally, but it will mostly stay in Australia. And Australia will join the list of countries I went through a few minutes ago, one more financial crisis in an endless series that causes damage and pain locally, but doesn't contaminate the rest of the world. There are a few countries in economic areas that are big enough where a crisis can contaminate the rest of the world. The U.S., as we found out, is at the top. A financial crisis impacting the entire Eurozone and not just the southern periphery might accomplish the same thing. A deep financial crisis in China might do so as well. And a crisis in Japan could rattle the world too. But Australia's financial system just isn't big enough to get even close. Ladies and gentlemen, I'm Wolf Richter of WOLFSTREET.com. Thank you for listening to the Wolf Street Report.